A man buys a house for $300,000. 30 years later, he tells everyone it's made him rich. Another man quietly invests the same money into the stock market. 30 years later, no one talks about it. But here's the uncomfortable part. Only one of them actually made more money, and it's probably not the one you think. Setup: why this matters now. Right now, more people than ever are asking the same question. Should I buy real estate or invest in stocks? It sounds simple. It isn't, because this isn't just about returns. It's about leverage. It's about time. It's about psychology. And most importantly, it's about the math people don't show you. Real estate feels safe, tangible. You can touch it, live in it, show it to your family. Stocks feel abstract, numbers on a screen, up one day, down the next. So people default to what feels real, not what actually performs. And that's where things start to get interesting, how the system actually works. Real estate. Let's start with real estate, because this is where most people feel confident. You buy a property, usually with a mortgage, meaning you're not using your own money, you're using the bank's money. This is leverage. And leverage is powerful. You put down, say, 20%. The bank covers the rest. If the house goes up in value, you benefit from the full price, not just your portion. That's the magic, or at least that's the story, because there's more going on, a lot more. First, appreciation. Historically, real estate grows around 3% to 5% per year, sometimes higher, sometimes lower, but rarely explosive. Second, cash flow. If you rent it out, you collect income, but that income isn't pure profit. You have maintenance, repairs, vacancy, property taxes, insurance, management fees. Suddenly that passive income starts looking less passive. And then there's the mortgage. For 20 to 30 years, you're paying interest. A lot of it. In fact, in the early years, most of your payment isn't going toward the house. It's going to the bank. So while you feel like you own the property, for a long time you really don't. You're renting it from the bank. How the system actually works. Stocks. Now compare that to a stocks. No tenants, no broken pipes, no midnight call. You invest money into companies, or more realistically, into an index, a collection of companies. And historically, the stock market returns about 7% to 10% annually, on average. Not every year, but over time. And that over time part is everything, because the stocks rely on one thing real estate doesn't use as efficiently: compounding. Your returns generate returns, which generate more return. And it builds quietly, almost invisibly. There's no rent check, no physical asset, nothing to show off. Just numbers growing in the background. And that's exactly why people underestimate it. The first layer of the math. Let's simplify. Two people, same starting point, $100,000. Person A buys real estate. Person B buys stocks. Person A puts $100,000 as a down payment on a $500,000 property. Leverage at work. Person B invests $100,000 in the market. Now, fast forward 30 years. Real estate grows at 4%. Stocks grow at 8%. On paper, stocks double the rate, but real estate has leverage, so it seems like it should win, right? Not so fast, because leverage cuts both ways. The hidden cost of leverage, that $400,000 loan, it isn't free. Over 30 years, you don't just pay back $400,000. You might pay $700,000 or more. Interest changes everything, and that appreciation, it's applied to the property value, not your actual invested cash. Meanwhile, your real cash outflow keeps increasing. Mortgage payments, maintenance, taxes, unexpected costs, every year, consistently, relentlessly. Now compare that to stocks. No debt, no forced payments, no hidden drain, just growth, compounding, and time doing the heavy lifting. Here's where it gets uncomfortable. When you actually calculate total return, not just property value, but everything: interest paid, maintenance costs, taxes, inflation, Real estate often underperforms what people think it earned. That house that doubled in value, it didn't double your wealth. It increased your asset value. Those are not the same thing. Meanwhile, the stock investor quietly doubled, then doubled again, then again. Because compounding doesn't just grow. It accelerates, slow at first, then all at once. And by year 20, it starts pulling away. By year 30, so why do people still swear by real estate? Simple. Visibility. You can see a house. You can't see compounding. You feel rent. You don't feel reinvested dividend. You remember the purchase price. You forget the total cost. And there's something else. A subtle psychological trick. Real estate forces discipline. You have to pay the mortgage every month. Stocks don't force anything, which means people panic. They sell. They interrupt compounding. So real estate often wins, not because it's better, but because people behave worse with a stock. Scroll social media. You'll see it everywhere. Buy property, build wealth, own assets, don't rent. Real estate made me a millionaire. What you don't see, the years of negative cash flow, the repairs that wiped out profit, the markets that they stagnated for a decade. Because real estate success stories are visible, stock market success stories are silent. No one posts a screenshot of 30 years of patience, but that's exactly what it takes. Now, to be fair, real estate isn't useless. Far from it. It wins in specific situations. When leverage is used carefully, when properties generate a strong cash flow, when you understand local markets, and when you treat it like a business, not a shortcut. It can outperform, but that requires effort, skill, time, and risk tolerance because real estate isn't passive. Its operation stocks, on the other hand, require almost nothing, consistency, time, and the ability to do nothing when everything feels like it's collapsing. That's it. No tenants, no debt, no operational headache, just exposure to global economic growth. And that's the key difference. Real estate is local. Stocks are global. One depends on a neighborhood. The other depends on the world. There's another layer most people ignore. Liquidity. Stocks can be sold instantly. Real estate cannot. If you need money fast, a house doesn't help you. And then there's concentration. Buying one property is a bet on one location, one market, one asset. Stocks a spread risk across hundreds, sometimes thousands of companies. So when something goes wrong, it doesn't destroy everything. At 5 years, real estate can look better. At 10 years, it can still compete. At 20 years, stocks start pulling ahead. At 30 years, compounding becomes dominant. Time changes the game, and most people underestimate how powerful that shift is because they focus on early results, not long-term outcomes. Here's the irony. The investment that feels slower is often faster. The one that feels safer carries hidden risks. The one that looks boring wins quietly, and the one that looks impressive often hides this isn't just about choosing between two assets. It's about understanding how wealth actually grows through time compounding behavior, not hype, not shortcuts, not visible assets, because the system rewards patience, but it markets activity. And those two things rarely align. So here's the real question. If real estate feels like the smarter choice, but the math often favors stocks, then what are people actually optimizing for? Wealth or the feeling of being wealthy? And if those two aren't the same, which one have you been chasing this whole